Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 288. And can you stay calm in markets when it falls? This is the question of the day, and I'll show you how SIPs are, doing so much better than a lot of lump sum investing, and the probability of your winning is actually much higher when you do a SIP. And we've done an experiment in the last 1 year. The 52nd SIP went in today, and we'll show you the results of this continuing SIP experiment. But first, I look at the markets. Markets remained reasonably volatile within a shorter span of the day, up and down many times. Pharma stocks and IT gaining about 1% each. FMCG also recovering 0.64%. Public sector enterprise and infra also doing slightly better. Metals, banks, autos and real estate continue to reel. PSU banks are now down 9.2% for the week. Real estate is down 8.8% for the week, and many others also down 7 to 8% for the week. So not a pretty picture for the week and for the month as well. So we are essentially playing a mirror game to the global moves now, but we have still done much better than a lot of global markets. So that is the only silver lining. We are yet to see what RBI has to say on Friday, and many are expecting a 0.5% rate hike here, and that is probably already discounted. But the result season is upon us, and with the result season will come downgrades or upgrades of forecasts from companies, and that will really be the kicker of the next trend up or down. The market, as you can see, Nifty 50, CNX 200, CNX 500 all flat. Mid cap, small caps, Nifty Next 50 slightly in the green, 0.2 to 0.5% up. Within the weekend investing small cases, MI 35 doing very well today, 1.4%. MI 50 doing very well, 1.2%. MI 25 0.85%, and MI 20 at 0.5%. All having some small cap component and hence doing well. Others were more in line with the respective benchmarks, with EverGreen, All Cap, ATH and NNF10 actually losing ground, so doing worse than the benchmarks. Heatmap for the day, you can see big losses in HDFC Bank, State Bank, ICICI Bank, Kotak Bank, Adani Ports, JSW Steel, Tata Steel, Titan, Maruti, and SBI Life. In terms of the gainers, Tata Consumers was up, Cipla was up, Power Grid was up, Shree Cement was up, Eicher Motors was up. Some small gains in ONGC, Reliance, ITC, Levers and Nestle as well. So IT has remained also stable today. In terms of the top CNX 500 gainers, Shree Renuka made a huge comeback at plus 9%. Aster DM plus 8.5%, Kalyan Jewelers 8.3%, GE Shipping up 7%, and IGL. In fact, all gas stocks were running up 6%. Varun Beverages has been continuously falling, minus 4.5%, Imami minus 4%, India Bulls minus 4%, EI Hotels minus 4%, and Brightcom Group also minus 4%. So this strategy that we started in October 21, right at the peak of the market, with the conscious attempt that what happens if you start a SIP right at the peak of the market, and of course we were guessing that the peak was there, and we were right actually. So we started this SIP on 1st of October, and we have completed the 52nd SIP today. The SIP XIRR is 24.91%. It was about 40% just a week or two back. The original portfolio, if you had done a lump sum, is up 14.8%. The benchmark index for this strategy, and this strategy is a private strategy, but it is a simple momentum strategy on CNX 200 stocks, 20 stocks in the portfolio, getting rebalanced every week. So nothing really rocket science in this strategy. This is like any other strategy that I have. The underlying CNX 200 index has actually closed, I think, about minus 2% for this entire period. So from October 1st till today, actually we'll also release these numbers from October 1st to October 1st, but today the 52nd SIP had gone in. The original the benchmark has done a negative 2%, whereas the SIP XIRR is plus 24.91%. So you can see that despite having started from almost the top, we are doing pretty well, given that we have sipped through this entire volatility of the last year. And I'll show you some charts right here. So this orange line is the XIRR number, which had gone to about 42%. The absolute return on the portfolio has been at 14.9%. Again, going to minus 12 or minus 13% drawdown in the middle in June. The absolute return for the strategy benchmark, which is CNX 200, has been in the negative from the start and only came back up a couple of times and has closed at minus 1.7%. And CNX 200 XIRR, if you had done an XIRR on CNX 200 index itself, that would have yielded about 5.4%. So you can see that not only the strategy did very well of 14.9 versus 1.7, but the XIRR SIP has done at 24.9% versus 5.4%. The dividend has also been included here at about 0.7%. So the numbers are there in front of you. The validation of an SIP started at near the market highs for a year is in front of you. Even if I say we were not doing the strategy, even if you were doing just the index and sipping in it, you would have made 5.4% versus 1.7% absolute return on the index. So the SIP part of an index over a longer period really benefits you, and that is the message that we want to give from on this part. So again, to help you keep calm in the markets, try to not expose yourself to the extent where your mental peace will go away. So keep sipping from your savings, save every month and keep sipping based on that saving. And you can see here 3 scenarios. Market just goes up one way, and you had a lump sum here. There, of course, that lump sum investment, had you done it there and market goes straight up, you'll do much better than bringing your money in with the SIPs. And that is one instance where SIPs will not do better than the lump sum. The second scenario is that market just goes down from where you bought, and SIPs will do better here because you're bringing in money gradually. And the third scenario, like we have seen in this last 1 year, is a range bound sort of volatile market where no real net gain actually has happened. There also SIP has done much better than the lump sum investment. So SIPs are doing better in most of the scenarios. SIPs are helping you to average into the system. But again, please be very clear that I'm not recommending that you do the averaging technique on any stock or any underlying that is not being rebalanced. So an index is a momentum strategy which rebalances every 6 months. Our strategies, of course, rebalance every week or every month. So at least you are assured that it's a self-evolving, self-correcting mechanism that you are gradually sipping in, and you're not sipping into a stock which may go from 100 to 10. Don't ever do that. So and of course there is no pain in trying to time the markets here. I mean, in my experiment, I have done a weekly sip, and I've religiously put in money every Tuesday, and there has been absolutely no pain of the falling market at times for me because of the ease of doing that business. One insight that I shared on Twitter today. So this is the Nifty chart, and you can see that the Nifty was sort of going in this channel at this pace till about the pre-COVID level, having tested this upward channel 4 or 5 times in the last 5 years. So my sort of thought was that had COVID not happened, and let's say business as usual would have continued, maybe we would have remained in this channel for the last 3 years, and maybe would have been near 14,500 or so by this time. And this is just pure, I wouldn't say speculation, but just study of what if COVID had not happened and business was doing as usual as before. Maybe something else would have happened, but just for argument's sake. And now here we have the COVID crash here, and then of course the huge global stimulus which took us all the way to 18,500, and that we've been jiggling since then. So now the question is that you cannot say that at 16,900 odd we are way above where we should have been. I mean, that's one way of looking at it, but I don't see it that way, because so much monetary stimulus has been pumped into the system that we are not comparable anymore to what has happened in the past. So this trend that was existing till 2020 actually has no relevance today, because if the overall money in the system was X, now probably we have like several X. So from that perspective, it's a apples to oranges comparison. Every boat, every asset class should have been lifted up to some extent, because there's money sloshing around which came out of nowhere. So you cannot compare today's asset prices versus what was back there, because the base has changed. Just like when the government changes the inflation base or some other base, cost index base, you are not able to compare between the previous series and the current series. This is the same thing that is happening, that whatever price earnings also that one was seeing earlier, and now they are not, I think most of these are not comparable, and hence fundamental analysis based on comparison of the past has become extremely erroneous in my view. And of course, I do believe that price action and following price action for your investing remains the best method for investing and making money, but a lot of people may not agree. That's okay. So one more sort of thought today, that I was meeting some folks yesterday, and they said maza nahi aa raha. If I do that, mujhe maza nahi aa raha. If I do that, then I get excited. So one must ask oneself, what is your purpose of coming to the market? If your purpose of coming to the market is to have fun and thrill, just because you may be bored, you may be earning a lot of money in your career, and you have so much money or to throw around that you don't mind just throwing darts in the market, and some may stick and some may lose, or just that the adrenaline rush that you get by shorting Adani stocks or something like that. So this thrill seekers is one way of coming to the market, and I invite all thrill seekers to do this, because these thrill seekers will give money to people like us who will go and invest in a structured way. Most of them will lose money. There is no doubt about it. So I invite all these thrill seekers to the market to please donate their money, so that other serious market players can make some use of it and gain that. Then there are genuine folks who are actually trying to make money for reaching their goals and for their retirement, and that is totally fine. And you can, most of the folks are like that. At least the intent is there, but they try to, forget why they're in the market, and then they start to do thrill seeking. Some people may be truly broke. Maybe they have blown out their account, or they've lost a job, they've lost in the business, and they want to make a comeback, and they want revenge, and they want some quick money. these people will also keep losing money in the market, because the intent is to somehow juice the market for a quick gain, and that rarely succeeds. Of course, there are success stories. I'm not saying it is 100% true what I'm saying, but more often than not, and barring exceptions, these people will lose money in the market. And to these people, I don't invite them to the market. Please stay away from the market. Please take good advice from your financial advisor. If you are having a tough time in terms of money, the stock market is the last place you should be coming to make a quick buck. And then, of course, there are others who are just trying to pass time, maybe some retired folks, maybe those who are interested and in the corporate world, like to follow corporate stories, like to do some investments here and there. And they are not really looking for any high returns or anything. It's just that, some time will get passed. They will be able to make intelligent conversation with others, so on and so forth. So those folks are also usually doing quite well, because they don't have much greed and fear, and their principles are very clear why they have come to the market. So once you know why you are there in the market, and you must ask yourself, a lot of times we don't ask ourselves and we forget why we are there in the market. You may be able to find the right type of investing, the right style of investing, the frequency of trade, what glove is going to fit you well according to your purpose. I think that will help you a lot. So my suggestion is, please do that study, or that what is that word, introspection. Congress uses this word a lot. Rahul Gandhi goes into introspection a lot. So please do some introspection and figure out why you come to the market and play accordingly. Thank you so much for your time. And once again, my request is, please share these videos with your friends and family. Please help others on this financial learning journey. These videos are for educational purposes, and the more you can share with your friends and family, the more people will get exposed to the markets, and they will have financial independence in their lives. Thank you so much. Bye.